All right. Good morning, everyone, and welcome to our inaugural mid-year 2020 Virtual Economic Outlook. I'm Steve Gormley, the Director of Portfolio Management here at KWB Wealth, and we want to thank you for joining us. It's very different from normal, but we're going to push through and give you our thoughts today. So just wanted to let you know that we are recording this today, so if you miss anything, or if you have friends or family that you think would benefit from watching the presentation, then it will be available on our website, kwbwealth.com, in a few days, hopefully sometime in the middle of next week. Second, I'd like to bring your attention down to the bottom of the screen. You can see there's a few buttons down there. One of them is a Q&A button. If you have any questions that you'd like to ask the panel, then please click on that button and you'll have a screen that pops up. You can type your question in there and we will answer those questions at the end of the presentation after the prepared remarks. And with that, let's go ahead and start the panel. Today we have with us President of KWB Wealth, Carrie Bubb. We have Chief Wealth Manager, Robert Bullock, Executive Wealth Manager, Diana Saylor, and Executive Wealth Manager, Mike Razuk. So first, let's start with Carrie. We had our last economic update in January. Could you take a few moments and provide us an update with what's gone on since then?
Yes. Hey, welcome everybody. Thanks for tuning in. And hopefully you forgot everything we said in the last economic update, because not much of it actually came to fruition. And I'll summarize some of the things we were thinking then and contrast that to what we actually see today. So back in January of 2020, we were telling people, you know what, things look okay. We have an unemployment rate of around 3.6%, darn near the lowest since the great Second World War. We had U.S. growth in the economy of 2 to 3%. Not great, but not bad. We had low interest rates, were good for the economy. We had low inflation, and the markets were high. No doubt about it. We had come off a record 2019, markets were high, but the one thing I didn't really see is the irrational exuberance that normally precedes a recession. And what I mean by that, a lot of times as markets really do well, people start drinking too much of the Kool-Aid. Hey, Carrie, let's get more aggressive. Let's get more aggressive. And, as we were talking with clients would say, Carrie, I'm okay. I just want to hit base hits. I don't need any more risk. I'm content. So it wasn't that irrational exuberance that sometimes, leads to that recession. So what has changed? Well, here we are in July of 2020, and the unemployment rate is no longer 3.6%, but in March and April shot all the way up to 14% because of COVID, and as companies began to deal with the changes of shutting down the economy. We started a recession in March of 2020, no doubt about it. I do believe we probably already are out of the recession and we are on the road to recovery. At least that's what the markets are telling us. But, from no recession in sight, as I was speaking in January, to, just 2.5 months later, all of a sudden we're in the thick of a recession. Quite a remarkable turnaround in such a short period of time. And I don't think anybody really could have predicted it. The other thing we saw is growth. You remember we were talking about growth being 2 to 3% in 2020. And what we have seen is growth has just fallen off the chart. In the first quarter of 2020, growth actually declined about 5%. The second quarter, which is just ended on June 30th, we don't have the final numbers, but it looks like growth is going to have fallen about 34.5%. That's a huge fall. The good news is in the third quarter, which we're starting to live now as things start to reopen, from the bottom, we're expecting growth to pick up, maybe about 20%. And by the fourth quarter, depending how things go with reopening and a vaccine and all the other things that might happen, maybe about 8%. But net, what we're seeing is growth in 2020 will probably go from not the positive 2 to 3 that we expected, but probably more like a negative 4 or 5% or so. And the other thing that's happened is earnings. Earnings are what ultimately drives stock prices. So as we were sitting here in late 19, early 2020, we were predicting the S&P earnings would probably be around $163 per share. And what it looks like is they're more like going to be $125. So that means earnings of corporations are going to be down about 20 to 25% in 2020 versus 2019. So if you think that earnings are going to be less, then you would think, well, shouldn't the stock market be less? And that's the crazy part of this is, we're flirting with the S&P, not quite at its high a year ago or at the beginning of the pandemic, but it's darn close to the all-time high within, I don't know, 5 or 7% or something like that. So what the market's telling us is, hey, we're going to get through this. The market's maybe looking out further, 6 months, 12 months, maybe it's predicting a vaccine. I think the recovery has started, but the market might be a little ahead of itself, and our kind of best guess is maybe we churn sideways here for a while, through the rest of the summer. We kind of see how things open up. We've had some false starts and whatnot, but the market's saying we're going to be okay. But boy, this was pretty unpredictable for most parties. So whatever we said in January 2020, just erase it.
Yeah, thanks, Gary. That's a good update. We've definitely been through a lot since January. Diana, Carrie mentioned the unemployment rate, and it's the highest it's been since the Great Depression. So, with that many people out of work, what is the impact on the economy, and are jobs going to bounce back as fast as economists seem to think they will?
Good question, Steve. So prior to the pandemic, it's obviously had a huge impact. Prior to that, as Carrie said, the unemployment rate was about 3.6. I think most recently it was 3.8%. But in April, we saw 20.8 million people file for unemployment. And when you compare that to the last recession, 2007, 8, and into 9, there were 8.6 million jobs lost over that time period, that 2-year time period. And it took 6 years during the last recession to recover that job market. And if you look at this chart, what it actually says is if we look at the last 10 recessions since 1950, on average, it took about 30 months to reach the previous employment peak. But what's also interesting, you can see on the far left, that's what we just experienced. But what's interesting is if you look at the years where you had the steepest drops, you also had the quickest recovery. So if you look at 1957 in the yellow, and then 1981, they were the steepest losses, but the quickest recovery. So is that going to be the same this time? Don't really know. This is obviously unprecedented times, but I think we're on the road to recovery. When you look at, obviously April was terrible, but May, there were 2.5 million jobs added back. And then in June, 4.8 million, bringing our current unemployment rate to about 11.1%. There's a lot of controversy around those numbers. And I think it's, being an unprecedented time, and we haven't gone through a pandemic before. So, a lot of these numbers are based on census answers and things like that. It's kind of hard to keep track of where workers are and what they're doing. So, those, we're just kind of going off of whatever the numbers are provided. So really, there's a lot of variables as far as jobs coming back. So as we're all experiencing right now, we have some states that really weren't hit hard in the beginning, but they're hit hard now for various reasons. And then also states like ours, where we're seeing increased cases. And so it's really going to depend on the rising number of cases. Is there going to be a vaccine? When? Government stimulus, it seems like there's most likely going to be some sort of stimulus package coming out soon. And then, the Fed, them continuing to prop up the economy as much as possible. So there's a lot of variables into this, but I think we're on the right path.
Thanks, Diana. That's great. And you said the word unprecedented about 2 or 3 times, and that's truly what we're going through. And so Bob, with it being so unprecedented, can we really look to history to guide us, in the coming months and years?
I think we can. Part of our job is to put things in perspective, frankly. And Diana had mentioned that this is the 10th recession since 1950. Yeah, this virus is a little bit different. Just to put a couple of things in perspective, though, we've gone through MERS, we've gone through SARS. Some of the callers may be old enough. 50 years ago, we were going through polio, and we know how all those ended. And so there's always a reason why we go into a recession. Let's see, 2000, it was the tech bubble. 2008, we happened to have a housing crash. And obviously 2020, now we're going through the recession caused by the virus. We like to remind clients that recessions are part of the business cycle. And what's a recession? Obviously, when sales drop, companies aren't making the sales, they're not making the income that they've had in past years, so they need to reduce expenses. What do? They let people go. And those people are obviously unable to make their mortgage payments. But we recognize that recessions are part of the business cycle. They don't last forever. A typical recession will last a year or two. Even as bad of a recession that 2008 was, it lasted 2 years. Kerry had mentioned that we may be out of this one. Well, obviously we went into the recession February and March and April, if you will. We'll look back in a couple of months to see whether we've actually are out of it. But every recession is followed by our growth cycle. Timing it is tough, and we caution clients that we can't control the business cycle, but we can control our emotions and we can try to control our actions. And so sometimes there's a desire of, oh, let's get in and let's get out. We would suggest that's difficult to do. If you're good at it, you're probably not on this phone call today. And so we would tell you to stay in, because we know that successful investors recognize that the longer that you're in the investment, the greater the chance for success. Let's say that you had a balanced portfolio. Balanced portfolio is typically 50% in S&P 500 stocks and 50% in bonds. You look at any 10-year rolling period from 1950 to 2019, you never lost money. Now, past success isn't guaranteed for future, but I think it's comforting to understand that at least for the past 60 to 70 years, a balanced portfolio has never lost money. And so we like to remind clients that you're in it for the longer term. There's going to be bumps along the way, but if you stay where you are and don't get out, there's a good chance that you'll do well.
Thanks, Bob. That's great advice as far as keeping a long-term perspective. And, you know, that's what we preach here at KWB, but we also have clients that like to look more in the short term. And so, Mike, could you kind of walk us through what the market might be telling us right now and what that means for the next 3, 6, or 12 months?
Yeah, so it's always difficult to predict short term what the market is doing. You know, we always try to be long-term investors, but I think, you know, a couple key things to keep in mind is the stock market is a leading economic indicator. It's forward-looking, and it's basically signaling at this point that investors are hopeful, that we think that there is going to be an economic recovery and we are going to get through this. You know, so it is a positive sign that we're seeing the market have such strength. And we always like to try to put shapes on recoveries. I don't know what it is with economists, but you might hear V-shaped recovery, W-shaped. Right now, things are kind of looking like a check mark. You know, we're having we had a fast tear down. We're having a pretty quick recovery, but I think that it's being a little bit slower than people had first thought we might see. But there is positive news with what the market has done. You know, when we have a really good quarter, when we look at the second quarter, I mean, the market really bounced back strong. And usually what that means is when we look the next 4 quarters out, we see almost a 15% gain in the S&P 500. So, you know, it's hard to predict the next 2 or 3 months because, you know, we're starting to see company profits that Kerry had mentioned, and they're not looking good. But when we have strength off of a big downturn, usually we see continued strength in the next 4 quarters going forward as well. So I think the market is showing us that, hey, we are hopeful for a recovery. We do think that things are getting on the right track and that there is light at the end of the tunnel here. Another thing that happens is when we look even further out, you know, the next 3, the next 5 years, usually when we come off of a recession and we enter a new growth cycle, the average market return is about 9.6 annualized. So maybe today it's still tough, but going forward, we might see some good strength and some good gains. And I would say the best short-term predictor that we have right now is just the breadth of the market recovery, meaning that, you know, when we look at stocks on average, over 90% are above their 50-day moving average. that means it's very, very likely that the worst is behind us, and we did see the market bottom on March 23rd. So hopefully we'll see continued growth going forward, and hopefully history does repeat itself and we see those nice gains, maybe not through this year, but into next year and into 2022.
Great, thanks, Mike. That's positive. It's nice to hear positives right now. So I think we can all agree that we'll probably see more volatility in the market as we have more COVID cases coming in and the ebbs and flows of those numbers continue. And so with that volatility, how do we plan and strategize for what comes next, Bob? Oh, Bob, it looks like, there you go.
It can be unnerving, to say the least. I mean, when the uncertainty comes, and you know there's always uncertainty, we try to always remind the clients to think longer term and to look at their long-term financial plan, because the headlines can be really scary. I mean, the Dow's down 1,000 points, the S&P's down 10 to 15%. You can lose your mind if you're watching TV every day or reading the newspapers every day. And so we try to focus once again on the longer term and get the clients back to their long-term financial plans. We also are reminded with that emotion, if you will, that we're human. And sometimes being human, we make decisions with our emotions. And that can be deadly at times, if you will. Sometimes good people make bad decisions at the bad time. And so sometimes thinking contrarian, sometimes when you're making a decision that feels really good, like if the market's down 40% and you want to get out of the market, that would feel really good. It may be a bad time to do it. So think a little contrarian. If the market's down, maybe a good time to be adding to your positions if you've got some extra cash. So I think thinking contrarian is useful for all of us. Recognize that once again, every recession has been followed by a growth cycle. And I think that's comforting to know that we go through these business cycles. Once again, we can't control the business cycle, but we can control our actions and at least tamp down our emotions. We all have a long-term financial plan, and regardless of what the uncertainty is, go back to that plan by continuing to fund your retirement accounts, your 401ks and your IRAs, continue to pay down debt, and obviously build up some cash. We like cash. We've always suggested to clients that they have a cash cushion of 3 to 6 months of their average monthly expenses. That's always useful. If you've got extra cash and we're going through times of uncertainty, if you will, a market downturn, consider, if you can, either reducing your monthly expenses if you're withdrawing from your retirement accounts, or maybe eliminating your monthly withdrawal in order to allow your portfolio to come back a little bit faster when that growth cycle begins again. And once again, if you got extra cash and the market's down 30 to 40%, as it typically does through every recession, think contrarian and maybe buy some stocks that happen to be on sale that day. Those would be my suggestions to the clients.
That's great perspective, Bob. Thanks. And now to Diana. I know you've told stories to us here at the office of clients calling in and asking how you're doing. You know, usually it's the other way around. We're always calling our clients, but you know, it has been a very difficult environment since we topped in February. So, but that's when we really provide the most value for our clients. So could you walk us through some of the things that we've done here that have helped clients over that time frame?
Sure, absolutely. It's been 11 years since the last recession, and I think it's easy to forget how stressful times like these can be. So this is a time when all clients should lean on us. This is why we're here. We're here to help guide you and hold your hand, and we appreciate everyone. And thank you for listening to us and trusting us through this crisis. It's been difficult, but I wanted to highlight a few things that we've done over the last year that I think really shows our value. Last year, we made a few strategic moves in one of our most utilized models. What we did is on the bond side, we reduced the longer term, lower quality bonds and replaced those with shorter term, higher quality, which the latter actually has performed very poorly this year. And then also we reduced the small and mid cap position and went to large growth, which that proved to be a good positioning going into 2020. And we made those moves. You know, the market's hitting all-time highs. We just thought, you know, what could we do? Maintain the same risk, you know, stock to bond ratio, but what could we do to reduce risk while maintaining those appropriate allocation for each client? So that's what we did, and I think that that was advantageous. And then also, you know, COVID hit. February 19th was the peak of the market, and then we were watching things. And one of the other models that we have called Guardian, which some clients were in, it was built to basically provide us signals of an orderly decline so that we could make decisions based on what was going on. But nothing was orderly about what happened. It was so quick and so fast. And so we proactively reached out to clients and suggested that, you know, we should really get out of this particular model because it would have reduced stock exposure by about 30%, which we didn't want to reduce stock exposure at that time. So that was a good strategic move. And then also on the cash management side, for those of you that are taking monthly income or you're taking one-time withdrawals, we are not reducing stock exposure at this point. We are using available cash and then also liquidating bonds. So that has been a good move. And then most of you know that when the CARES Act was passed earlier this year, RMDs were not required this year. So we reached out and informed everybody, and some have taken advantage of that. And then also Roth conversions. For those of you that have not participated in a Roth conversion and are interested, we're happy to go over that. But those that do those annually, we tried to take an opportunity to convert at that time. And, you know, with not having to take RMDs, we were able to actually convert more for some. So that was a good move. And then just, you know, like what Bob was discussing, you know, we're long-term investors. Going through this, it was so quick and so fast, and we decided not to make any moves through this time because, you know, we've been through this before, and we all know that trying to time the market is not a good thing, and most usually are not successful. So I think the moves that we made in 2019, we were in a good position going into this year, and then just staying the course and not doing anything rash through this crisis, I think proved to be beneficial. So.
Great, thanks for walking us through that, Diana. Mike, you know, Diana mentioned it earlier. We've had record stimulus through this time. And, you know, I think that moving forward, we might have to rethink some of the strategies that we've had in the past and some of the tried and true strategies that we've had. So could you walk us through what the stimulus means and how the economy has responded to it and what that might mean for portfolios going forward?
Well, the stimulus has been dramatic, to say the least, and I think that it raises a couple long-term concerns. You know, in the short term, we were trying to keep businesses alive, you know, give people the resources to, you know, continue working through the shutdowns. And I think long-term, what could potentially happen here because of that, though, is we can see inflation start to be an issue longer term. And so, yeah, I definitely do see some adjustments that we might have to make in portfolios in order to really take advantage and to set people up well for the next 5 or 10 years. So a couple changes that I likely think are going to happen is, you know, for one, people are going to have to get out of their comfort zone and probably have a higher stock allocation than they're used to. And I know that sounds a little intimidating when we're coming out of a recession. You know, you like your safe assets. But I think that, you know, what's occurred over the last 10 years, even with treasury bonds, I mean, let's take a look at those. You know, you used to be able to get 6, 7% in interest. And then you also benefited from bond prices going up as interest rates went down. So, you know, when we look back to 2000, we've basically seen interest rates decline, which boosted bond prices. So fixed income benefited you in 2 ways. And I think now when we look at the 10-year treasury, people are getting 0.63% if they give their money to the government for 10 years. That's sad. That's not going to overcome rising inflation. That's not going to overcome distributions that people may be taking. And this is an odd moment where the dividend yield of the S&P 500 at 2.33 is more than you can get in bonds. So to put that in perspective, if you had more stocks and those stocks gave you no capital appreciation for the next 10 years, you still made significantly more money holding those stocks than being in cash, being in treasury bonds. So yeah, I think the traditional 60-40 allocation, 60% stocks, 40% bonds, is likely going to have to be revisited. And for clients to overcome the potential inflation, distributions going forward, they're going to have probably 75% of their money in stocks. We're going to need that higher growth potential to overcome those two things. So I think that will cause a major shift in how portfolios will need to be allocated for people to have a good return. The other thing that I think will likely happen is, I mentioned higher stock exposure, but a lot of portfolios have been pretty concentrated in U.S. markets. And it's because there hasn't been too much to be excited about with international markets. But I think when U.S. markets have had such a good recovery, good strength, we need to look to, well, what's the right answer for the next 5 or 10 years? And when we look at the valuations, the prices of emerging markets, international markets, those are very inexpensive at the moment. And I think that there's going to be a lot of return potential in those markets going forward. And so I do think we're going to see higher stock exposure, but even a more historic tilt towards the international emerging markets. And I just mean a more academic weighting in those areas within portfolios. So, we've been light in the last 4 or 5 years. We will probably have a tilt to those in the next 4 or 5 years. So those are some of the things that I think, these stimulus and the policy and the general direction of the market are going to cause us to change within portfolios.
Great, Mike. Thanks for that answer. That's, there's a lot to think about, and I think a lot of client conversations that we'll be having in the next, 3 to 4 years about all of these things.
Yeah, and actually, I think some investors might have already be seeing that because, just as I said earlier, it baffles us a little bit is how can earnings be down so much, but yet the market is still up so much? And I think there's 2 things going on. FOMO, fear of missing out. People that got out or people that have been on the sideline, they've been bidding up these prices because they're fearful of missing out on this opportunity. And longer term with some of the charts Mike had that, hey, it looks like over the next 6, 7, or at least the next 4 quarters, history tells us markets ought to be pretty good. And there's a new acronym I heard, it's called TINA. There is no alternatives. In other words, at 0.6% on treasuries, if you don't put your money in stocks, it's really going to be hard to achieve your long-term financial gains. So anyway, remember TINA and FOMO. And go ahead, Steve.
Yeah. So we have one last question. I think it's on everybody's mind, and we've already got a few Q&As lined up about it, but we have avoided it till now. But the election, we have an election coming up in November. So, Carrie, could you walk us through what you see happening, prior to November 3rd and after November 3rd in the markets and with the election?
Yeah. You'd think that, this happens every 4 years, and it's been going on since 1776. That we'd kind of just clue in and know that, it's going to happen. We're going to get through it and whatnot. And then I hear things, no, Carrie, this is so much different. And I think it's different because there's a lot of other things going on around us. A pandemic. We just had a recession. We have now the mail-in ballot controversy. We have Twitter accounts that are being hacked. And we have an unpredictable president, and we have the oldest presidential candidate running since the beginning of time. So is it the presidential election that's causing us all this whatever anxiety, or is it just all the other noise that's kind of coming in and being in our brain and certainly on the news and all the other things? So I think what the most important thing is try to leave your politics at home. One of the things I always try to do is when I come into the office, I try to think of myself as a white eraser board, and I try to leave the biases at home because it really doesn't help me. And I try to focus on the fundamentals in the economy and what's going on. So one of the things that we're seeing right now is the economy is going to be, really it's going to be about profits and earnings and the stock market in these next coming months. And the reason for that is history tells us if the stock market is positive in August, September, and October, so August is just around the corner, the markets are positive, there is a highly probable result that the incumbent will remain as president. Now that said, the history also tells us, but if we've had a recession in the 1 or 2 years prior to the election, the incumbent doesn't always win. You know, so we just had a recession. So, all right, now it doesn't probably win, but you know, if the markets are positive August, September, and October, history tells us that the incumbent would probably win. So, you know, I think there's 3 possible outcomes. Obviously, the first one is the status quo. Status quo is Trump wins, the House and the Senate are divided. We do not have one government that has control of everything. And is that likely? Well, it's getting less likely because when you look at the polls, even last night, I think Trump had 11% under Biden in a lot of the swing states. So, you know, I think also, though, there's a silent group of people that really don't want to say they're voting for Trump. You know, they might want to, they're going to vote for Trump, but boy, it's controversial and whatnot. You almost think like maybe you're crazy if you say you're for Trump. So one of the outcomes is status quo. And I think the markets would be okay with that. You know, better the devil you know than the one you don't. But again, the probability of that is starting to diminish because of some of the polling, if that's correct. The next one is, you know, Biden wins and the House and the Senate remain divided. And so if the House and the Senate remain divided, what that tells us is no one party can just push through their agenda. They're going to have what we call gridlock. So what Rachel just put up was on the far right is where we have the split Congress. In other words, if you see the blue is the earnings of the S&P 500, the yellow is the growth rate. And what has happened historically is we've had the best returns when we have had a divided government. And that means gridlock. And again, no one can maybe push through all of their goals and desires. The one in the middle is more of the 100% Democratic. You'll see growth rates of 3, but you know, markets only earning 10. And then the one on the far left, which isn't likely this time at all, that would be a Republican sweep, not going to happen. So the 3 alternatives, status quo, Biden wins, we have a split Congress, and the third one would be a completely Democratic swing. And that goes back to the middle where, hey, markets are still historically averaging 10, growth is still around 3.3, and I think most of us would be okay with 10% over the long run. So, you know, watch the next 3 months. I think it's going to be interesting. I think maybe our anxiety is more about all the other things happening today. You know, the pandemic, the recession, interest rates, unemployment, all the things that are going on. And, you know, we've gone through this every 4 years. I've had, you know, clients that say, I hate this guy and get me out. And that's been detrimental. I have other guys that, hey, I love this guy. And, you know, and 4 years ago, people felt differently about that guy. You know, so try to focus on the economy, try to focus on the fundamentals. And while politics is interesting, it's not a great thing to talk maybe at a dinner party. Well, we can't go to one anyway. But yeah, you know, just sit back and try to filter out a lot of the news because the news is trying to, you know, get you to tune in, and it certainly raises anxiety levels.
Great, thanks, Kerry. I've jotted down a few notes throughout the panel, and I just wanted to kind of reiterate those points. I think first came from Bob is if you're still working, continue putting away money into your retirement accounts. I think that's the best course of action you can take is save as much as you can. And if you're retired and you're, you know, you still have a long-term time frame, no matter what. You could be 70, and if you live to 90, you still have 20 years to invest. So you got to remember that your time frame is almost always going to be long-term. Next is, you know, from Kerry, try to filter through those headlines. Remember that what you're investing in is not a person or a party. You're investing in companies, and no matter who's in power in the government, these companies still want to make money and will do everything they can to do well, no matter what the environment is. So that is the main thing to remember is it's not about who's in power, it's about what the companies are trying to do to get around some of the policies that those people in power might put in place. And last, you know, if you're frustrated, if you're scared, give us a call. That's why we're here. We're here to be your behavioral coaches through all these things. And we know that there are people out there that don't have those coaches or don't have a plan when things like this happen. And so if you know anyone who you want to help, who you think we can help, then please tell them to call us. We're looking to help people. We love helping our clients, and we want to help more people. That's really what we're all about here. So with all that said, I think we can get to the Q&As. We got some questions here. The first one I've already read, and it's about a specific online retailer, but I think, you know, I want to broaden it out as opposed to just the one stock. I don't know if we can really talk about individual stocks here, but let's talk about the winners and losers that have come from this pandemic. And Carrie, could you kind of touch on, you know, not just that one, but, you know, all of these winners and losers that have happened and maybe the things that have accelerated through the pandemic?
Right. Yeah. I think when I sit back and watch the lucky companies that were positioned to benefit from a COVID-19 environment, boy, they're just hitting it out of the park. And the big five, of course, are Amazon, Google, Facebook, Microsoft, and Apple. Yeah, and when you look at the S&P 500 today, those five companies are making up 20% of the value of the S&P 500. So huge concentration. And these guys have just kicked it out of the park. And if you were essential, if you were a Costco or a Walmart, boy, you did great, boy. But if you were in the travel business and you were Delta and you were a cruise line, or you were, box office, movie theaters, box office receipts are down 99.8% year over year. Travel at the TSA gates are down 72%, you know. And I think what COVID did is it accelerated the demise of some of these companies that haven't adjusted. JCPenney's, you know, Sears died a year or two ago. Some of the restaurants that Soup Plantation, whatever, never going to open. Nordstrom closed 16 stores throughout the country. So it makes me a little nervous because that much growth in those few companies reminds me a little bit of what happened in 2000. In 1998 and 1999, I remember we were all trying to become Y2K compliant. And when we became Y2K compliant, what we had to do is spend oodles and oodles of money in computer systems so that when the clock rolled over, we would be okay. And our ATM machine would work, our phone would work. And so as we spent aggressively, some began to believe, well, that's going to last on into perpetuity. Well, once 2000 rolled around and everything was okay, guess what happened to technology spending? It plummeted because we already bought all the new computers. We already did all these things. So a little bit of this is, let's say in 6 months we have a vaccine. You know, are we going to be doing as many Zoom meetings then? Are we going to Netflix as much? Are we really going to want to just get out of the house and go to the movie, or maybe go to the mall because that's a form of entertainment? You know, so I think here recently there has been some huge winners that, you know, they didn't plan it. They were lucky. And there's some others that were running a good business like the airlines. They were doing fine. They were growing. Transportation flights were up. Airlines were being ordered from Boeing. And all of a sudden, you had this exogenous event like the pandemic that just put everything on hold. And it wasn't that they did anything wrong. It's just that the world has changed. So be careful with some of those high-flying stocks that are doing phenomenal. I do wonder in the coming months or a year, you know, will things get a little bit more balanced, and maybe, you know, Zoom won't be so high-flying and we'll actually be able to do the next event, you know, in person. But what is kind of cool about doing this on Zoom, everybody, is that we're getting people from parts of the world that haven't been able to come to our meetings. I think in Oregon, Pennsylvania, and all of that. So I think this is something we've got to keep doing, but hopefully we can also, you know, see each other in the future face to face.
Yeah, definitely. So the next two questions are about the election. I think we kind of touched on those and answered those. The next one, back to Bob here. How much cash should we keep in our money market accounts during the next year? And I wonder if this question is kind of touching on, should we maybe elevate the level of cash depending on, you know, how you feel for the next year or so until we get through this?
Well, typically the baseline would be thinking about your average monthly expenses for the household. Let's say that's $5,000 a month. You really should have somewhere between 3 to 6 times that sitting in your local bank or local credit union. And so if the average monthly expenses for the household is $5,000, you should have somewhere between $15,000 and $30,000 sitting in savings, checking, money markets at your local bank or credit union. That's the baseline. Some people want a little bit more just so that they can sleep at night. And that's where I would start. It may take you a while to build up that amount of cash cushion, but that's a good starting point. Anything above that, once again, think contrarian. When we have recessions and the market's down 10, 20, 30%, it would be a good buying opportunity, and I'll leave you with that.
Great, thanks, Bob. Next question is, what are the outlooks for RMDs for next year? How about Mike? How about you take that one?
I was hoping you'd pick me on that one, actually. I think that we're going to have them again, personally. I mean, when you look at the amount of stimulus that's occurred, we have to be able to pay for that some way. And, you know, the big reason why we have required distributions is, you know, the government doesn't want you to defer those pre-tax accounts indefinitely. They want some of that tax revenue now. So, you know, they force people to take those distributions so these accounts don't pass on to beneficiaries, you know, and they get to continue to defer. So I do think in 2021 we are going to have required distributions again. And, you know, the government tends to give us breaks when we have, you know, a really unpredictable event. But, you know, with the market recovering as much as it has, I think that there is a good, strong chance that we are going to see that in 2021.
Yeah, I think you're right. Next question is about, you know, let's say there is a Democratic sweep. And let's talk about, you know, do you think there will be tax increases that happen if that were to happen? And I think the question is kind of getting to if there's increases in taxes, you know, will that have effect on our portfolios? So who wants to take that one?
I'll take it since I talked about, yeah, I think the markets are going to be okay if we have status quo. I think the markets are going to be okay if Biden wins and we have a divided Congress. We'll get through that. I think the markets will probably be a little more challenged, uneasy, if we have a full Democratic sweep. And the reason is we're likely to see corporate taxes rise, which means you're going to have corporate earnings decline. We're also likely to see maybe higher taxes for different individuals or just a rollback of what Trump did. It's set to expire anyway in 2025, so it's not permanent. But I think the market would be more challenged with that. And then, of course, increased regulation, you know, whether it's for the oil drillers or, you know, different businesses and corporations. I think the market at first is going to have a challenge with that. But then I think you said, Steve, you know, the other neat thing about capitalism and corporations and whatnot is, you know, once we know the rules, once we know what we have to deal with, we seem to adapt and move forward. So the best thing we can hope for is just clarity. Whether it's a Democratic sweep or divided, you know, the sooner we know the rules, then the sooner corporations can manage around those rules to, you know, modify, to adapt, to create the opportunities and the profits that they can, which ultimately helps, you know, all the shareholders. So it'll be a little bumpy, I would think, but it's not the end of the world. We've been there before.
Yeah, I think you're right, Gary. If a large number of people were to miss their rent or mortgage payments, what impact do you think that'll have on the economy? How about Diana? I think you touched on, you know, kind of unemployment, but we've also had this massive stimulus. So could you touch on, you know, renters and, you know, people paying their mortgage and the banks and all that kind of stuff with that question?
Yeah, it's so uncertain. You know, I mean, I think if we get another stimulus package and if there's this continued support, I think that will help the situation. Now, the question, it did say the markets. I don't know if it's referring to employment or the job market or the stock market, but you know, we mentioned before, stock market's forward looking. So I think it's already assuming that we're going to have issues like that. But again, it really just depends on this virus. You know, are we going to get it contained? Are we going to have a vaccine? Can people get back to work? And then really it's going to depend on the stimulus and what support we have for that. So it's going to take a while to see. But as far as the markets go, I think that it already assumes that we're going to have certain issues like that. So it's forward looking. So I don't know that the market per se, unless it gets really, really bad, like an issue with the housing market, then that's a different story. But I think that we're on the road to recovery that way.
Great.
And I think the bank stocks have already felt it. You've seen bank stocks get pummeled. They've already priced that in. There's having to put more loan loss reserves to the side. So I think some of that is priced in. But they also, the really bit of good news too, is when we came into this in February or March of 2020, the banks and the financials were so much better in shape than we were in 2000 and 2008 or 9. So the good news is we're starting off at a much, much better financial balance sheets than we've seen in a long time. So if this is going to happen, it's better it happened today than in 2008 or 9, because many of the banks would be gone. So the good news is the banks are in much, much better shape than they were. Credit quality, you know, if anybody's refinanced lately, they know what kind of things they have to go through. You know, they don't take stated income anymore. They want to see your tax returns. They want to see your bank statements. They want to see where the cash came from. So these guys are in much, much better shape than, you know, 08 and 09.
Yeah. All right, here's one. It's not like a question, but I do have a question that kind of came from it. So moving money from an IRA to a Roth IRA. So let's go to Mike. You know, what are the reasons that you would want to do that? You know, I know we've done that for clients this year, and there are great reasons why you want to do that. Could you just, you know, touch on some of those?
Yeah, I think I love the saying that Carrie has said previously. It's, would you rather pay tax on the seed or on the harvest? And really what that means is within a Roth IRA, all the earnings is tax-free. So it's like you're swallowing the tough medicine today, knowing that all the growth that you're going to have in that account in the future is yours. And so when we look at, you know, the market environment, we look at the stimulus packages, what is the more likely case? Are taxes going up from here, or are they going down? I think that we will see higher taxes at some point. I don't want to put a specific time period of when, but if you are afraid of raising tax rates, you might want to pay some of the taxes at today's tax rates, and that would be through a Roth conversion. So, you know, it's always a decent strategy if you're willing to pay the taxes. If you have cash to pay the taxes, that's when it's most effective. And, you know, again, if you're looking long term, you're probably going to be glad that all those earnings that you converted are going to be yours in the future. So it is a good strategy. It makes sense for some people. For others, it doesn't. If they're already in a high tax bracket, it's an extra hard pill to swallow. But that's if you're looking very long term. It usually is going to be beneficial for people.
Great. Here we go. Here's one for Bob. I think we'll give this one to him. So we covered if there's a split Congress. We covered if there's a Democratic sweep. But let's say all the polls are completely wrong and we go all Republican. What, you know, do we expect that the stock market can kind of continue the run it had over the last 4 years if that were the case?
The stock market would continue to go up only if corporate earnings are there. And so it's not the politics. Carrie had sort of touched on it. It's the certainty of what the policies are. So companies and corporations can maximize their profits by making investments today and obtain the fruits of those earnings somewhere down the line.
Right.
So it's really not whether it's Republican or Democrat. It's the certainty of the policies, and the corporations will then adapt to maximize shareholder return.
Yeah, I think that's completely right. And here's the last question. So, you know, we have a spike going on in COVID cases, and states are reversing, and some are on hold, but some are still opening. But this is basically asking about another round of stimulus. And I read this morning that right now in Congress, they're kind of trying to attempt to pass one for next month of $1 trillion. But let's even go past that. You know, if we keep getting more spikes or more cases, do you think that stimulus can just kind of continue? I'll just throw that out to anybody.
Well, that'll be interesting, I think, because now then politics might start to play. You know, at this point in time, Trump knows he's got to do everything he can to keep this market positive between now and November. You know, if Biden wins and he decides, you know what, we just can't afford it, we don't have the capital, whatever. You know, if you're a president, what you want to do is get all the ugly stuff out in the first year or two. You know, so he would not be as compelled, maybe, to support the stimulus because, you know, at some point in time, you know, the deficit hawks might raise their heads. We haven't seen that yet. So I think that the next president won't have as much of a motivation because, you know, by the 2024 election, right, we'll have forgotten what happened in 2020 and 2021, right, would be my thought.
Yeah, that's a great point. Okay, we did have one more come through while we were answering that one, and it's that we do have rising cases also in emerging markets, places like Brazil and India. And, you know, do you still feel like that's a good place to invest, you know, given those facts? And how much do you think of a long-term portfolio should be in emerging markets?
Who wants to take that? Yeah, I'll just chime in and anybody else can add in too. Yeah, you know, I think the whole thing is if we get a vaccine, that vaccine is going to be distributed and everybody's going to be on the bandwagon, and that can happen very quickly. I think our view on emerging markets is purely about valuations, and these markets have not participated. The US has had a super strong dollar. We have high deficits. So emerging markets look positive because A, the dollar from here on might weaken some, and it's just purely from a valuation standpoint. And it goes back to reversion of the mean. You know, it's hard for the US to outpace everybody indefinitely. It just doesn't happen, at least historically. Now, maybe this time it's different, but every time I hear this time it's different, it's usually never different. But that's why I think emerging markets. So the answer to that is, you know, kind of depends on your time frame and whatnot, but anywhere from 5 to 10% of a portfolio easily should be considered to be in emerging markets.
Yeah, and if you look at the numbers, you know, if you started investing in 2000 and you didn't have any international, if you didn't have any in emerging markets, you would have been very upset. and then for the last 10 years, if you had an overweight there, then you're upset. So it just comes in waves. There's not, you know, and we don't know when those waves are going to shift. So it really just comes down to having a comfortable amount in those places to, you know, be diversified. It's a story of being diversified. So.
And I think also for the people who keep asking about the politics of it, it's a diversifier. So if you're concerned about politics here in the short term in the United States, international investing is attractive, you know, from the valuation perspective, and it's not tied to politics in the U.S.
Right.
Yeah. All right. We want to thank everybody for attending. I think this was a really good thing to do, and like Carrie mentioned, I think we'll continue to do these just so we can reach more people. You know, we want to have them in person, but we also want to give people the opportunity, if they don't want to drive in from wherever they're at, to see our faces and get our thoughts. And just as a reminder, we will have this hopefully posted sometime in the middle of next week. So if you want to rewatch it, or if you have anybody that you want to send to it, it'll be on kwbwealth.com.
Great. Thank you, guys. Have a great day.
Thank you.
Bye, everybody.